Hi, audience who have come to today's webinar. This is an educational webinar that we do as a Chief Investment Group. My name is James Kandasamy. Today, I'm having Josh Belk, who's going to be doing a tax-focused webinar, which is basically getting ready for end of the year and other wealth killers, which is caused by not knowing how to do your taxes properly. Just to introduce ourselves, my name is James Kandasamy. We're a deal sponsor focusing in Austin and San Antonio. We have like almost 0.5 billion in assets under management, 4,000 units. We used to manage 4,000 units. We sold half of it last year. 19 apartments is also what we have managed. Right now, we have like 7 apartments. And we have like almost $80 million raise, around 1,000 units and Class A under development. I think 300 units under construction right now. We're also vertically integrated as asset construction and property management. I'm also author of the 2 best-selling book, Passive Investing in Commercial Real Estate and Smarter Doctors. You work hard, make your money work harder. On the left is my wife, Shanti. She runs the property and construction management. And also, if you want to join us to see more, follow me in Instagram using James Kandasamy. And we also have a large multifamily investors group in Facebook, almost 20,000 people there. But you should be able to get hold of me through social media. Just look for my name, and I should be in LinkedIn, Facebook, and Instagram. So without due delay, I'm just gonna give it to Josh Belk. Josh, why not you introduce yourself? I mean, I don't want to do injustice not introducing all your credentials, but why don't you go ahead and introduce yourself? Then I'm going to promote you as a host. Then we can start presenting.
Wonderful. Yeah, Josh Belk. I own Lodestar Tax and Consulting. We're an accounting firm, primarily lead with tax. About 800 to 900 corporate clients throughout the country, and real estate is kind of our niche in regards to where our clients sit. Either they have full-blown real estate investors, or they have real estate heavily within their portfolios, whether active or passive, inside and outside of their retirement accounts. So that's kind of who I am. Nothing all that spectacular, but we fortunately get to spend a lot of our time in this space trying to help clients that are, especially those that are looking to get into real estate. Especially.
Yeah. So Josh and Josh is my CPA in the current real estate. So brings a lot of credibility to the space. So, reach out to his firm, and, I'm sure he's going to put his contact information later on. So Josh, I'm going to make you the host right now.
Okay.
So at least you can start presenting, and please use the Q&A box to ask any questions, and we'll try to get as much questions answered as possible. This is a webinar, but we'll also do it as a podcast series where I will be asking questions to Josh as we go along, and so that we can publish it as a podcast as well. So Josh, go ahead.
Okay. All right. So what I'm going to do here is just going to kind of make just a few introductory comments, and I'm going to hop in a little bit to talk about some of the tax law changes that we saw go into place into 2023. 2 pieces of legislation that went through that will impact probably most of you, if not all of you. And then I'll make just really kind of run through a list of some areas maybe you just need to consider, be aware of, and then just kind of act accordingly. Especially we're kind of up to the end of the year, so you're kind of right at the last minute of trying to make changes, any sort of tax reduction strategies you want to implement. You're going to kind of really need to get on those pretty quick. So we'll talk about some of those, and then we'll kind of wrap things up and try to address any sort of questions that you may have. So I have a podcast, Belk on Business. As far as my contact information, whatnot, you can obviously just find me online. I'm on LinkedIn, easiest place to find me. I'm not on other social media platforms. I'm not really my thing. So, but I am on LinkedIn, and the firm information is there, as well as my podcast information. Okay, wealth killer. So originally I saw the promo on this, just kind of thinking about what are things that kill our wealth, and I just kind of made a list here. It's kind of the top things that you kind of generally will see with people as it relates to, and this is kind of both. It's going to be both on the kind of consumer and also on the business end. So lack of savings. Of course, a lot is talk about savings on the personal end, but this also could happen on the business end as well. If we don't plan accordingly, a lot of times we focus more on the investment side or a lot on kind of growing our business, kind of pushing that forward, but not really focusing or looking into making sure that we have adequate savings both on the personal and on the business end. We have had clients, and I've seen this many times, that they get themselves in trouble. They didn't adequately plan, didn't adequately budget. They end up taking a lot of kind of predatory type debt or consumer type debt that really can drain their businesses and sometimes can't put them out of business. Lack of investment discipline. This is where someone like James really can kind of help you, come alongside you and help you with this. And that is kind of having that discipline there. So you're not going after the newest and the hottest, the greatest idea. I was around, as probably many of you were, in 2000 when tech stocks were the big thing, and we saw a lot of people lose their shirt. And then with crypto, we've had clients lose millions of dollars in crypto, just kind of chasing the newest thing kind of can get you in trouble. Really kind of aligning what is your purpose when it comes to investing, be consistent with it, and then don't focus quite as much on trying to time the market or to try to time necessarily your investments. Not being adequately insured, I think that's fairly straightforward. Poor lifestyle choices. So lack of knowledge or counsel as it relates to our finances, both business and as well as personal. Underperforming assets. So in this environment where we have inflation that's gone up quite a bit over the last couple of years, and then so if we end up with an asset, if we're lending or whatever the case may be, and it's only getting us 4 or 5%, inflation is 8%, obviously that's going to eat away at our wealth. And I think the two biggest ones, and we're going to talk about a little bit today, and that's going to be the last two, taxes, and then just simply a failure to plan. And so we'll talk about that a little bit more as we go through this. So when I speak on stage, I almost always put up this slide or mention this in some form or fashion. And this really is to kind of set the paradigm as it relates to as far as our tax system. So of course, a lot of people have opinions on taxes. Some people feel that it should be there as far as a redistribution piece. Other people feel that it's kind of to punish people for making money, whatever the case may be. That's a lot of kind of emotional. Ultimately, the tax system is built out in a way to get taxpayers to act in a certain way. So when they begin to implement things, whether it's Congress, et cetera, that passes these laws, essentially it is to get us to do certain things or to act in a certain way. And I'll give practical examples of this as we kind of go through this. So they do essentially award or punish taxpayers depending on how they go about deploying their capital. So if there's a savings credit, for example, that's put out there is to get encourage people to invest in their retirement accounts. We see this with the Inflation Reduction Act that was just passed, deploying money into energy, for example. Simply to get us as consumers, as taxpayers, as businesses to act in a certain way. So let's kind of talk a little bit about the tax changes that went into place this last year. So the 2023 changes. So first is going to be a drop in bonus depreciation. So since the Tax Cut and Jobs Act was passed in 2007, in October of 2017. It began a process of allowing for certain asset classes to qualify for bonus depreciation or full accelerated 100% depreciation in year one. So a lot of our clients that are in real estate professionals would utilize a cost segregation report, have a cost segregation study done on a property. And what it does is it takes that property, which normally if it's a residential property would be depreciated in its entirety, the non-land portion anyway, over 27 and a half years, commercial over 39 years. And what a cost segregation study does is it breaks that property down into its smaller components. So anything that had a 15-year life or under, so any sort of land or leasehold improvements, any sort of property so basically any property or any part of the asset from the walls in. So we think of furniture, fixtures, et cetera. Those get depreciated either over 5 or 7 years. All of those asset classes was able to be 100% fully depreciated from 2018 through 2022. In 2023, that bonus depreciation drops to 80%, in 24 down to 60%, and then in 25 the rules will we go to 40%, and then in 26 it goes back to the not having the bonus depreciation. That's assuming that that nothing changes between now and 2 years from now. So
I think
meals I have
Josh,
dropped down to 50%. So let me kind of make. I'm sorry, James, you were going to say something?
yeah, I have a question. So on the bonus depreciation, because a lot of people who came into the real estate market when it's 100% bonus depreciation, right? So what happened when when there was no bonus depreciation? So is that the 27.5 straight line depreciation? Is
Correct.
what it was?
So residential and I'm going to say commercial that is not a hotel, something to that effect. So if you have but I'll stick to residential here. So correct. If you have residential, multifamily, et cetera, those are over 27 and a half years. And so without this bonus depreciation, the non-land would be fully depreciated over 27 and a half years.
Got it. Got it. So, okay. Unless something changed in the election, and that might
Right.
change as well, right?
So it's not going to completely eliminate the usefulness of a cost segregation report. So even if it goes back, you can still have a cost segregation report done. Now you have to kind of weigh the benefits of spending the money on it. But what will happen is that even you can still break it down into smaller components, but those smaller components will be depreciated over 5 years, 7 years, and 15 years instead of the 27 and a half years. So it would still allow for some additional depreciation in year one, just not as much.
Got it. Got it. Okay. Go ahead.
Okay. So the meals it goes back to 50%. Over the last few years, it was 100% deductible. Form 8300 is a form that needs to be prepared and get sent in if you collected $10,000 in cash during the course of the year from any taxpayer. This form needs to go out. That's the compliance piece. And then as we look forward to 2024, we have this BOI reporting, which if you're an owner of so it's a beneficial owner report that needs to go in. It's a FinCEN report. So if you own a business and you're over a 20% owner of that business, this report does need to be filed. So you'll want to make sure that you connect with your accountant to make sure that this report gets filed. And it is something that I'm not quite sure if a lot of people are aware of at this point. But if you're listening to this, if you do own a business that you own over 20% in, then this report does need to get sent in. Please make sure you connect with your accountant. You have the entire year to do it if the business is existing. So you can file it at any point in 2024. If it's a new business that you start in 2024, you need to have the report filed within 90 days of setting up that entity.
So questions
okay. And so,
on the meal. So was that used to be 100%? Is that business meal, and now it's only 50%?
That is correct. So this was a pandemic change that was put into place during that kind of helped during, I think it was part of the CARES Act. And so that increased meals to 100%, and then now it's back down to 50% starting in for January 1st of 23.
Okay, I didn't know that. So all the business meals is now only 50%
That is
deductible?
correct. That is correct.
And this Form 8300, is this something new, completely new in 2023?
It is. So historically, if you've ever, and for some of us who are old enough when we used to work in the world of cash, we would, where if you had some sort of a retail a location or whatever the case may be, if you received over $10,000 in cash, and it could have been just in general, you go into the bank and you do the deposit, they run this report. That still happens when you go in, if you take in over $10,000 in cash at any given point. So this has changed now to where they're putting the onus on us as business owners. So if you go through and you collect during the course of the year, so James, you're a client. So say during the course of the year you decide to pay, pay over $10,000 in your invoices in cash. Then at that point, I would need to file that Form 8300 disclosing our information, your information, and that over $10,000 in cash did exchange hands.
So is that the same as, there's a lot of restaurants where asked us to pay in cash and they gave us like 5% discount? I think I was always think that they're always trying to avoid
No,
paying taxes, but is that
yeah, my
to
my
catch
editorial
this?
comment on that is probably because I mean that they could avoid putting it in their POS system and they don't have to pay taxes on it.
Correct, but would this cost them to report that, or they may
No,
still?
because it's not a single it's not unless you go in during the course of the year and spend over 10,000 in the restaurant, the restaurant's not going to need to report it on you. So this is basically you're looking at one taxpayer to another.
Oh, got it. And can you explain a bit more on the BOI reporting, because that's something new?
Okay. I'm sorry, James. What was that?
Can you explain a bit more on the BOI reporting?
Correct. Yeah. So all that will be, um, and we aren't sure fully what all is going to be on there. But it, for the most part, from what we understand, it's going to be at least a disclosure of the owners and their personal information. It's probably driver's license, passport information, that type of thing.
Would that be equivalent for even like passive investor? Let's say passive. I think if a pass is it also for passive investors who owns more than 20%? I know it's a bit rare to find a syndication world who owns more than 20%, but it
Right.
could be.
That would be correct. Yes.
Okay.
So if you're in an
So
equity position.
if you're an equity position, you're passive, you own more than 20%, then you still have to do this BOI reporting separately from the K1 that you get from your.
That is correct. That's separate
Oh,
from the K1. Yes, sir.
okay. Okay, sounds good. Yeah, if anybody in the audience have questions, use the Q&A box to type your questions, and we can go through it while we present or at the end.
Okay. The Inflation Reduction Act. This is directly related to the IRS, and that's what these 3 bullet points are here. It had 3 components to it as far as the so there's kind of 3 basic prongs, 3 areas they're wanting to look into as it relates to the IRS. And that was the enforcement. So that was the whole, 80,000 IRS agents getting hired coming after you type thing that you heard. The technology piece. So some of the money was supposed to go in to help with technology, and then also with communication. Communication and technology kind of goes hand in hand a little bit. So we've seen some of this start to take place. The enforcement, of course, they were saying that they're going to only go after larger, higher income taxpayers making over $400,000. Somehow if you make 399,000, you're okay. If you make 400,000, you're evil. But those making over 400,000 that apparently were bad people for making money, the IRS was going to spend more time going after them. What we've seen in practicality over 2023 is that's not what they're doing. And here's the problem that we're having, or that they're having, not our problem, but that they're having is there's no way in the world they hire these people, they can train these people to be able to audit some of these more complex type businesses or these higher income taxpayers. So what we're really starting to see are smaller Schedule C type businesses getting audited. And every audit that's come into our office this last year has been exactly that. It's been your small, low 6-figure businesses, making 100,000 gross and 30,000 net. Those types of businesses are the ones right now they're on. I think they're trying to just kind of get these people to cut their teeth on some of these other types of audits. What we expect, if indeed that they do decide to move forward, that for those of us on the call that are higher income and taxpayers, that we may end up seeing more audits. And then the technology and communication, if you've ever had to try to deal with the IRS, get through to them, deal with them online, whatever the case may be, it's about impossible. So they are making some work to improve it, and we have seen some moderate improvements over the last few months, meaning they're at least responding to things now. Okay, the Inflation Reduction Act continued here. So a big part of this was investment into clean energy. And there were 2 big areas into this. There's 30% energy tax credit for homeowners. This also, and this is low and moderate income. So you see that acronym LMI, low and moderate income taxpayers. And then, or if you happen to be a multifamily, and if you have multifamily properties that rents to low and middle income taxpayers, you also would qualify for this credit. Otherwise, if you it is only meant for homeowners, and those, there's also government and some other entities that are also included in this. So for our clients who are interested in investing in solar to get the credit, usually they're going into a solar fund. to where essentially the fund purchases the credits from the homeowners, and then that credit passes through to the investor. And that is perfectly fine. And so that's usually what this looks like. And we've seen clients save some material tax dollars by doing this. Now, whether or not the ROI plays out on these going forward, the homeowners actually pay and buy these things and that type of thing, we'll have to see how that all plays out. But at least the tax credit piece so far is turning out pretty well for clients. The electric vehicles component. So any electric vehicles, the cost had to be under $55,000 if it was a vehicle, $80,000 if it's an SUV, et cetera. Most electric vehicles are over that, and then the tax credits are extremely complicated. It has two halves at $37.50, and then there's a mineral component, another component. It's pretty complex, and we'll see how that all plays out. The other piece of legislation this last year, Secure Act 2.0, and it did a few things. First of all, if you have a 401k, and it allowed for additional catch-up contributions if you're over 50. 529 roll-ups. If you have a 529 plan for one of your children, for example, and if the account's at least 15 years old, you can roll over $35,000 from the 529 into a Roth IRA. Okay, and that starts in 2020. That starts in 24, and then the qualified charitable distributions. So if you're over 70 and a half, you can do a qualified charitable distribution into a charitable remainder trust or charitable gift annuity up to $50,000, and of course you avoid any sort of tax consequences. And then, or you can do a QCD directly to a 501c3 up to $100,000. And we do have clients that are taking advantage of this, and then the required minimum distribution has been increased to 73 years old.
And what's the reason behind this Secure Act 2.0? Why did the government put this in?
I don't know the onus behind it, James, on why they did this. The first Secure Act that was passed here a number of years ago, the Secure Act really kind of focused more on kind of the investment side, and so why they did it, I'm not quite sure.
Okay.
I'm sure there's plenty of commentary on it. Okay, so let me kind of talk a little bit about just things that maybe some of this you may be aware of, some of it you may not, but just some areas I think anybody who's getting into real estate really needs to have a good understanding, or at least be leaning into their accountant to make sure that they have a good understanding of these areas. So first of all, active versus passive. So if you're in real estate passively, okay, so you go through and you buy, for example, a single family rental, you put it into service, you have a W-2 job, and you have somebody else manage it for you. If you have losses on that property, you cannot take any losses. So all those losses essentially get carried forward. If you end up changing from being an active investor to a passive investor to an active real estate investor, it can become very difficult to be able to release those losses short of selling the property. So just kind of understand if you're an active investor or you're a passive investor. If you're actively involved in the management of the property, you can take losses up to $25,000 in the course of the year, and the excess will be carried forward. And that's in entirety, it's not per property. And then if you are an active real estate professional, then your losses are unlimited. Okay. So that's kind of the first thing that you need to understand. I have real estate professional on this sheet. A real estate professional is someone who at least 750 hours in real estate activity. Okay, and that is defined on what that real estate activity is. That's non-clerical real estate activities. And then over half of your time, half of your income needs to be earned or garnered from real estate. Now, if you're a large W-2 income earner, whatever the case may be, you may want to look, maybe a spouse would qualify. We do have a number of high income earners where the husband or the wife, they may be an executive at a company or whatever the case may be, and they're making high six or seven figure incomes. Then they may have their wife work to become, or their husband to become, the real estate professional, so they can unlock some of the additional depreciation that can come through either investments and syndications or into their own properties that they purchase. So if you're looking to go that route, you need to look into the real estate professional status. Another thing to understand, and it may be something that may be useful, is the rules as it relates to a short-term rental versus a single-family rental. So a short-term rental, some people call these, vacation rentals, Airbnb, Vrbo, these types of things. A short-term rental that has an average rental time frame of 7 days or under during the course of the year, that becomes active for an active piece of real estate, which means you can be a passive investor but still be able to use the depreciation or losses against your other active income. Okay, so if you do have a vacation rental, for example, if you look at over the course of the year and your average rental time frame was 7 days or under, then it would be considered active, and then you could offset. If you have losses, you can use those losses, whether it comes through ordinary losses or through additional depreciation, to be able to offset some of your other active income, such as W-2 income. If it's over that time frame and it's a short-term rental, then it's considered passive and is handled basically the same way that a traditional single-family rental is handled for tax purposes.
So let me clarify that on Josh, because this is it's a bit tricky subject for a lot of people. So on the Airbnb or short-term rental houses, you said if you stayed in the property for more than 7 days, you are able to qualify for the depreciation for that house. Is that correct? What you said?
Yeah. So I'm forgive me, I was not clear. So no, if you have a single, so you have a vacation rental, and you go back and you look at the average length of a stay over the course of that year. And if the average length of that stay was under the average length of stay, so you had somebody stay 3 days, somebody stay 10 days, somebody stay 14 days, another person just stay for the night, etc. If you go through and you add all of that up and you divide it by the number of people that rented the property during the course of that year, and that number comes out to under 7, then you can put it on a Schedule C on your income tax return or on page 1 of your business return. And then you can use the losses to offset active income and to be able to get some of your dollars that you paid in through withholding tax, et cetera, back.
Okay, got it. What about I think I've also heard of the short-term rental that you can claim up to like $100,000 deduction. When did that come into effect? Is that correct?
I am not. You may or may not be correct. That I'm not familiar with.
Okay. Yeah, I've heard about like some people who own a short-term rental and they're able to claim up to like 100,000 deduction. I'm not sure how they do it, but there must be.
Yeah, I'm not familiar with, James, and it's possible, but it's not something that I've heard or I've seen.
Okay. And on real estate professional, I mean, I think just for the audience, there's a lot of people who doesn't know that, right? So if you are working full time and if you have like a few, I mean, I don't know, there's some qualification, right? So how many X number of rental houses? I think if you have a spouse who doesn't work, you can always get that spouse to manage that houses, I guess, right? And make sure that they're able to register more than 750 hours, right? And they don't have to have a license. They don't have to be a realtor. A lot of people come to me and say, do I need to be I just took a license. I say, why? Oh, I don't be a real estate professional. No, it's not true, right?
Right. Yeah. You only need the license if you're going to be managing other properties. And most states require a real estate broker's license to be able to manage properties, but you don't need that to manage your own.
Yes. Having said that, I'm not a CPA. I mean, Josh probably not going to give, I don't know whether you want to give direct advice or not. Please consult your own CPA for the specific details, because it really depends on each individual tax situations.
Correct. Yeah. So I didn't put the disclaimer up front, but I think that's understood. Yeah. So yeah, don't rely on anything that I say here or James. Consult your own tax professional. Like I said, we have a question here. Richard, beyond personal web recommendations, how does one best confirm a quality tax service provider if one is just a partner and not a real estate syndicator? Oh, so there's 2 questions here. So the best way to confirm a quality tax service provider, probably the best your best route is going to be to find individuals that are in a similar situation to you and talk to and find out who they use. So because in this day and age, Google reviews, all this type of stuff is not necessarily helpful, especially when you're trying to find a more of a tax strategist or higher end person. If you go to Google reviews for my firm, for example, they're very few. It's just not, people aren't out there on Google doing reviews, and when you're talking more higher end tax strategy, that type of thing. So usually your best connection is going to be through connecting with people in your network and find out who they use and who they recommend. So that's the best way, and verify their credentials. Make sure that they're if they're doing your taxes, they're either an enrolled agent or CPA. They're the only two that can represent you in front of the IRS. That is key. So verify licenses, and then so that's kind of probably the best feedback I can give on that. If one is just a partner and not a real estate syndicator, how critical is a tax advisor that is fluent in real estate specific tax laws? If there's material reason to an advisor that's in the same physical area. So there is no reason to find someone in your physical area in this day and age. We, of our 900, between 800 and 900 clients, I would say that a small fraction of them actually within 50 miles of us. So in this day and age, it's not important at all. Now, when it comes to fluent and real estate specific tax law, now if you're just getting a K1 and it's just a pure investment for you, it's not important at all. But if you're looking to find out ways that you can unlock additional depreciation, or figure out how you can leverage, if you're getting into a syndication that's offering you, for example, year one additional depreciation, something to that effect, and you want to figure out how you may be able to unlock it, you're going to need someone who understands the rules. So, Richard, I don't know if that answers your question or not, but okay. And then Dwayne asked, I built a vacation home in 2023 that I have not rented out this year. If I rent it out as an Airbnb on December, do I just need to rent it one time under 7 days before December 31, 2023? Yes, tremendous question, Dwayne. And we actually just had two people on calls, my year-end calls this last week, that we exactly had the same exact conversation. Yes. For your case, Dwayne, don't know you at all, but that's very, very good. So yes, definitely. Put it in, as long as it's in service, and you rent it one time for under 7 days, but before the end of the year. In service means that it's capable of being rented, and you have it under 7 days. Yes, have a cost seg study done. You don't have to have the cost seg done by the end of the year. You can have it done. You need to just have it done before before you file your tax return, and then you can unlock that additional depreciation and offset against your active income. Okay. Anything else on that, James?
No, I think let's go ahead.
Okay, we'll continue on then. Yeah, just yell at me on as far as on time. Okay, with bonus depreciation going away, at least to real estate, we're going to see probably more clients start to utilize Section 179. So you're not going to be able to use this in real estate in your, if you have a single family rentals or multifamily, for example, you aren't going to be able to use Section 179. But if you own a business and you have, say a piece of commercial property, or you have a warehouse, you have a manufacturing business, whatever the case may be, you can utilize the Section 179 depreciation. And so basically, once again, kind of going anything from the walls in, and this isn't on a new build or on a new purchase. So that's sort of any sort of improvements, then you can utilize Section 179 and take the full depreciation in that year. De minimis rules, if you're in real estate and you have expenses in your property, so you go through and you have somebody come in and you're not quite sure if it's considered an improvement or if it's just simply a maintenance expense, if any expense that's up to $2,500, you simply can expense and not have to worry about whether or not it needs to be capitalized, aka depreciated, or if it can be directly expensed. The only thing is here, you do need to have a company policy that states such. So anything up to $2,500 that you can write off. Now, if you have audited financial statements, you can go up to $5,000. Okay. Most businesses and most individuals don't have audited financials, but otherwise you just have a policy that allows for any expense up to $2,500. You can just directly write off and don't have to worry about Is this just maintenance, or is this an improvement that has to be depreciated? Okay. The limit on Section 179 is if you're married, 2.89 million, so just under 3 million. So unless you have a lot of personal property or qualified improvement property, you're probably not going to hit the limit, and that's per year. And then we talked about the bonus depreciation on the Section 179. Okay. Another big area that's catching people with the rules over the last few years is understanding the basis in their entities. So you're looking at you need to have an understanding of what your basis is in your company. Your basis essentially is the money that you put into the business, less the money you've taken out of the business, plus your retained earnings, okay, and your net income. So if you kind of lump all that together, if you end up with negative retained earnings, okay, then you would not be able to utilize. You may not be able to utilize your losses. So essentially, you may have losses in a business, but you may not be able to use them. So make sure you understand what your basis is in your entities. Also, if you take distributions in excess of your basis out of any of your companies, it's going to end up getting taxed, even if your company lost money. So you could end up in a situation where you end up with double taxation. So just at a really high level, for sake of time, because this could be basically a webinar on its own, just make sure you always understand what your basis is in your entity, and make sure that you're working and you use that in light of when you go about taking distributions out of your company. So leaning into your tax advisor and your CFO, whatever the case may be, so you have an understanding of what your basis is in your company, so you don't create additional tax exposure, or you end up with losses locked up that you can't use. Okay, and then a lot of people, they focus a lot of their time on their P&L and not necessarily on their balance sheet, but make sure you have a good understanding of what's going on in the equity section of your balance sheet. If you Form 3115, change in accounting period. So if you're in real estate and you want to go back and have a cost segregation done on a property that you bought in a previous year, but want to recognize the depreciation in the current year, you can do so. So say you bought a property in 2021 and you want to go ahead and have you don't want to go back and amend your 21 return, you can have the cost seg done in 2022 and then recognize the additional depreciation on your 22 or on your 23 return, but you have to file this form. Okay. So just kind of make a mental note on that. Hopefully your accountant is aware of this, but just you may want to jot this down if you have an accountant that's not up to speed on all this, to make them just make sure they're aware and be looking for this form if you indeed go about doing that. Depreciation. Depreciation is kind of one of those things. Well, I'm just going to choose not to recognize the depreciation because I don't want to, because I want to show a higher net income, whatever the case may be, on your tax return. First of all, that's not technically permitted under IRS rules, but if you do end up doing it, you essentially will lose that depreciation. So when you go and sell that property, even if you didn't take the depreciation, you're still going to be forced to have acted as if you took the depreciation, thus reducing your basis in the property, increasing your capital gain. And then when it comes to depreciation, you need to have a consistent use of your depreciation rules. So you can't pick and choose, what you do. I'm going to do bonus depreciation here, not do bonus depreciation here. And so you have to just make sure you're consistent with your use of your depreciation. So if you do utilize bonus depreciation, for example, you have to consistently use that bonus depreciation on that property going forward. Okay. So that's kind of in a nutshell, I think, some of the high end. The only thing I didn't mention on one of the slides was alternative minimum tax. So I had that AMT on there. So if you end up in a situation, if you're a passive investor, so this isn't real estate, just in general, if you're a passive investor at all, and you create net operating losses, then and you're a little bit of a higher income taxpayer otherwise, your income is going to get calculated two ways for tax purposes. It's going to get calculated the ordinary way and also through alternative minimum tax. So make sure when you're going through and you're utilizing any sort of strategies to reduce your income with passive income, make sure you're having a conversation with your accountant, with your tax professional, to make sure that you're not running into a situation where you're going to get hit with alternative minimum tax.
What about I think that I heard about some new tax bracket that was recently introduced.
For 24,
Yes, that's what I heard. Is it 24? I think, yeah.
let me.
Do you have any clarification on that?
I do not. I know that they changed they do most years, but let me. I am not sure for 2024. I haven't looked that far ahead yet on the new
Yeah. No, there was some news
tax bracket.
came up on the tax bracket being changed.
Okay.
Either tax bracket change or the highest tax bracket become.
Yeah. So for 24, yeah. So you end up 35, 37%.
Correct. Yeah.
So, yeah, there's not a new tax bracket. They just changed the amounts. So the top bracket's 37. No, you're right. You went from 35 to 37. And then you'll end up with an additional 3.8% additional Medicare tax on top of that as well.
Mhm.
And that's if you're earning over, if you're married over 731,000.
Oh, okay. And below that, it doesn't apply.
Yeah, that's at the 37. So when you're below that, the 35 starts at 487, 32 at 384. And so, yeah, so it's 10, 12, 22, 24, 32, 35, and now the 37.
Got it. So let other people ask questions. Otherwise, I have other questions. So there's a question from me.
Yeah, can you offset W-2 income with K-1 losses? If it depends. If it's in box 3 on your K-1, which is rental income or loss, you can recognize it up to your basis, but otherwise you would not be able to beyond your basis. So, for example, you put $100,000 into a syndication deal, you would be able to take up to your basis, but you would not be able to take anything beyond that.
So if
and you would need to be also, you would have to be a GP and not an LP.
So if they are LP, are they able to use any of the?
If they're LP, they would not. It would carry forward.
It will carry. I mean, it will stay in their tax return, but carry forward. So one day, if they have I think if they have a passive gain, then they should be able to use passive losses, right? Is that correct?
So right, you can So you can offset the those K1 losses against other K1 gains, or other, or if you have other passive gains.
Correct.
So so you can use it to offset other income, but not W-2 income.
Yeah, I think W-2 income is active income, right? You can't
Correct.
offset that. But what about the $25,000 that everybody gets? Can they offset against that?
That is so if they're passive, if you're purely passive, meaning it's a K1, they would not get up to the 25K. That would be if they had a single family rental, for example, or a multifamily that they self-manage and they don't hit the 750 hours. So they're active in the real estate, but they're not a real estate professional. They can take up to the 25,000.
Got it. Yep. Yeah. Hope that clarifies to people, me who has asked that question. I mean, tax is a complicated topic, right?
It is complicated and it's fluid. So, I mean, literally what we talk about today could change. Like even the short-term rental, the 7 days. So that was 30 days, 30 days or under. Now, and then he just came out and arbitrarily changed it to 7 days earlier this year. So, so it's kind of one of those things that, things are fluid. Tax court sometimes change laws, and of course legislation as well.
Yeah. I think me also had a question. What is LP and GP? So LP is basically limited partners, which are passive investors. GPs are the active person in the deal. So let's say usually on a syndication, the GPs are the one who does the real work, buying the asset, signing on the loan, and managing the asset, whereas LPs are more passive investors where you just contribute the funds and you don't do the real work. So that's on the syndication. And I think even any LLCs, right, you can have a primary person who's doing the real work. They can be the GP, and everybody else is just a passive, right? So it's very well laid out in my book, Passive Investing in Commercial Real Estate. It's a very simple book. You just look it up in Amazon. It's $20, but it gives you a lot of information that you otherwise have to pay for in a lot of guru courses, right? So, but at very high level, that's what it is between LP, limited partners, and GP, who's a general partner.
And those who are, heavily either real estate professionals or can use those losses. A lot of them will work with people like James in regards to structuring their deals in a way that they can release those year one losses as a GP.
Yeah.
Then they revert to an LP in year two.
Yes. Any other questions on the Q&A? Otherwise, I can ask a few more questions. So what happened to the passive investors who are passive and they just keep on getting depreciation, right? It just stays on in the tax return until when the property sells, what happens?
So when the property sells, then at that point, those losses are unlocked. So essentially, it would reduce their capital gains at the point of the sale of the property.
Okay, so there's definitely still got benefit at the end at the capital gains side of it, right? So
right. So you essentially just carry the losses. So all it does is increases your basis in the investment. And so when the property sells at that point, it's just a difference between their portion of the sales price versus their basis at that point, which would be the money they put in plus their unrecognized losses.
got it. The other question I have for Josh is whenever people in any business where they do a return of capital as part of the operation instead of a return on profit, right? I mean, return as a profit versus return of capital, right? So when they give a return of capital, so that's just going to be a capital return, I guess. There's no tax.
No tax consequences on
no
that.
tax
Correct.
on that. But if they put it as a profit, then there's tax on it. Is that right?
That's correct.
So that could be a reason why some people do return of capital, right?
Correct.
Okay.
Yeah, because sometimes you may go into a deal and then they refinance and then return your capital. But then you have to realize that if that's what happens, then it would reduce your basis in the investment, which may put you in a position where you would not be able to recognize losses at that point.
Got it. Yeah. Finance and sales are pretty straightforward. I'm talking more about the operation profit itself, the operational distribution. So there are people out there who does a return as a capital, and I always thought that was not a good structure. But I also learned from some people who invest professionally, and they say they love that model. So it's just a revelation for me because they said, I don't have to pay tax until I get back my capital, right? It reduces my risk as well. So if there's no other questions, I think we are good. So if we're going to be recording this, this is being recorded and we're going to be sharing the recording. So please, listen to the recording offline. And if you're listening to this podcast, please join our email list by coming to achieveInvestmentGroup.com. Our newsletter or email list, we have like almost 5,000 people reading my newsletter every week, right? We have like more than 10,000 people in our email list. So our readership is 50% every week, and that's pretty good for a newsletter. So there's a lot of benefit that we give in the newsletter. It's very customized. It's a lot of fun newsletter too. So Josh, any parting words? You want to talk about your firm and how you can help out?
Well, yeah, I mean, for anyone listening, make sure the December's tomorrow. Reach out to your accountant, get your year-end tax planning call in if you haven't done so already. Until we can have that conversation, so you're aware what you may be facing, and then any sort of changes you need to make before year-end or deployment of capital before year-end to reduce your tax strategy. Make sure you get that done in December. So as far as the firm end, I'm not necessarily looking for any more business. We're kind of it's kind of one of those things. Definitely don't have a problem finding clients, but I encourage you if have a podcast out there, rather direct people there, Belk on Business podcast, and we talk about tax and as well as a lot of just general business principles in that particular podcast.
Yeah, and can you tell the name of the podcast again?
Yeah, so it's Belk, my last name, Belk on Business.
Okay. Okay, Belk on Business. Yeah, I saw a few advertisements. So awesome. All right. Thank you so much. Thanks, Josh, for
Sure
coming
thing.
in.
You have a good day.
Thank you. Bye. Bye, everyone.